So have you noticed that the REITs, real estate investment trusts, they have basically been about 20 to 30% down year to date. And when we look at the real estate prices, possibly in your area, but I can tell you for sure in my area, they haven't dropped that much, right? So there's a disconnect. There's a disconnect between how the publicly traded real estate funds are trading versus how the actual assets are trading, right? So if you look at housing prices, let's say here in Canada, in Toronto, they have maybe come down a little bit, but not as bad as how these REITs are trading. You also hear that Blackstone, BlackRock coming out and saying, and Blackstone especially, saying that they were having withdrawals issues with their funds, and they're unable to give the investors their money back. And they also said that, but you know what? Even though we can't give our money back, we've done well in our fund. We're actually up in our fund. So what does this mean? Why is there such a big disconnect between the private markets, right? Like, people who are managing these funds like Blackstone and Sons and BlackRock, and saying they're up for the year, while the REITs are down 30%. And mostly I would say that the reason for this big disconnect is because how the private markets trade versus the public markets is very, very different. Of course, it's very easy to go out and make bets on the public markets and see quotes real time, every second, every minute, versus the public markets, which you're going to have to create a market for. You're going to have to find buyers, and if you're in a market where there's no buyers, what are you going to quote it as? Zero. You're not going to quote the property at zero, right? You do have sellers, but maybe that sellers seeing that their house is not being sold, so they take it off the market. And if they take it off the market, the supply is, you're not seeing much of the supply in the market, and not much of the demand, and the prices are not moving that much. You can see that it's very different, because you're dealing with an asset, and you have an asset which is not as liquid as a stock or a REIT, where you can sell very fast. And most importantly, when you look at these REITs are trading at a discount compared to their actual assets. So the assets may be marked and worth more than whatever their prices are, whatever the REIT prices are. And they're trading much at a discount. And this has to do with a lot of the fear that these traders have when they're investing in these REITs. They can easily pull out money very fast. And when that happens, it's a trickle effect, which would cause that discount to happen, right? And especially when you're looking at the stock market likes to think 6 months in advance of what is coming. So definitely these REITs that are trading at a discount, again, this is not financial advice, but these REITs that are trading at a discount, they have probably had a lot of traders that were pricing in that, hey, with higher rates, it's definitely bad for real estate, and probably pricing in, depending on the type of property it is, right? It could be residential, could be commercial, could be office buildings, and who owns those office buildings is also another question, right? And factoring that in and figuring out that whether the returns are going to be the same, especially heading into 2023, will probably be kind of very, very different than what people would be expecting in the actual market, the actual physical private market. It would be very different, because in the public markets, you would have that 6 months thinking priced into those REITs. So when I look at those REITs, right, those REITs that are pricing in that real estate is going to be or expected to do poorly with all these rate hikes, while the private market is looking like for example Blackstone saying that we're still up for the year. When I look at those REITs, it basically suggests to me that either the REIT market or the private market, one of those two, are either wrong or right. And if the REIT market's right, then that may mean that the private market, like Blackstone with their fund, maybe those prices need to now converge, and those actual assets, you might see it coming down because you've got traders who are thinking 6 months in advance by trading these publicly traded stocks that this is what's coming. This is the valuation we see down the road through the rate hikes, and especially when you do a cash flow analysis and you increase the interest rates, it brings down the actual value of your asset. So if that's what traders are pricing in for through these REITs, then, and if these REITs and these traders who are discounting these REITs, if they're right that the true valuation should be around there, then those assets may have to come and converge to those prices. Now, if the REITs are wrong, right, and we don't see real estate do so poorly as expected, then that poses an opportunity, which many may be thinking, because with this massive discount, you may be thinking, oh, okay, this is overly sold. And, part of that selling could be also a bunch of fear in the markets. So since this is overly sold, and if the market doesn't drop that as expected, then those REITs that are at a discount could be a good bet for some investors out there. And then those prices may converge, which means that those REITs you may see those REITs in the next 1, 2, 3, I don't know when, years, however long it takes, especially when rate cuts happen, you'll probably see those REIT prices move up to the actual asset value and to actual levels where it should be trading. So let me know what you guys think. Leave a comment below. Hit the subscribe button, the like button, and the bell icon to be notified on the next video. And I'll see you guys around. Cheers.